What's up guys, Ben here and welcome to Motivation to Invest. REITs or real estate investment trusts are investment vehicles designed to give you exposure to the property market without having to save up a massive deposit and get a mortgage. You can invest in these REITs just as you do normal stocks. These REITs can be powerful investment vehicles providing great cash flow. So in this video I'm going to deep dive into REITs, see exactly what they are and how you can invest into them. Without further ado, let's dive in. Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investment tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on, that way you'll get notified when a great stock is at a great price. So that being said, let's get into the video. So what is a REIT? A REIT or real estate investment trust is a company which owns a selection of income producing properties. Generally, these properties are commercial developments such as office blocks, warehouses, hotels, and even shopping centres. There is even a number of residential REITs which give you exposure to the residential housing industry. These can provide targeted returns of over 8%. Which is better, investing into REITs or property directly? Well, there are many benefits of investing into REITs. One is that they are extremely diversified. Investing into a REIT stock could hold hundreds of properties across the entire country. Another is that investing into REITs offers a lower barrier to entry and is extremely easy to do. For example, if you wanted to invest into a property directly, first you need to save up a big deposit. So for buy-to-lets in the UK, this will be 75% loan to value. So a 25% deposit on the average UK house price of £200,000, you need approximately £50,000 to put down to invest in a property directly. Then you need good credit to get a mortgage, and then once you own the property, then you've got to manage tenants, you've got to deal with maintenance and a lot of other hassle. Whereas with REITs, you can just invest directly and achieve a great return completely passive. Of course, you can achieve even higher returns by investing into property directly, as you can add value with renovations. However, the extra time required to add this value must be added into your calculations when you're investing. The benefit of REITs is they are completely passive, easy to do and fast. You can invest from as little as £6 or $6 into a REIT. So how do REITs make money? REITs make money by renting their properties out to commercial tenants, charging them rent and then distributing this rental income to the shareholders in the form of a dividend payment. By law, they must distribute 90% of this rental income after expenses. So how do you invest into REITs? Well, REITs are publicly listed companies and you can invest in them just as you would any other stock. Remember, a stock is just a portion of a company. So when you own a REIT, you actually own a small portion of all their properties. So which REIT is right for you? Well, this depends on a variety of factors, but generally you want to look for those with the highest paying dividend income and also those with the most reliable dividend. So look at their commercial tenants. If they've got people such as Tesco, Unilever, Subway, big chains as commercial tenants, then you can assume that their dividend may be more reliable.
You also want to look at what industry or location are the properties located. So are they in a major city? Are they in Singapore? Are they in the UK? Are they in the US? These are all factors which you need to take into account when investing into a REIT. You can also look at the industry. So does it contain mostly offices? Is it retail? Is it residential, healthcare, hospitality, industrial? Each sector has its own specific characteristic that will affect a REIT's growth, risk profile, and performance. In general, office REITs usually offer higher yields compared to a retail REIT. However, office REITs are also more volatile and less resilient than retail REITs. This is because during a recession, some businesses go bust, demand tumbles, and office rents fall in tandem. The economic cycle largely affects the performance of an office REIT. Then of course you have property yield, which is related to the dividend yield. Property yield is the amount of income a REIT can generate from the property. For example, if a property is worth $10 million and earns $400K in rent in 1 year, then its property yield is 4%. So the questions you need to ask is it high, is it stable, and is it rising? So look at the history of the REIT and the up and coming economic conditions. Another factor you need to look at is the debt to asset ratio, or the gross gearing. The gearing ratio represents a REIT's amount of debt over its total assets. The higher the ratio, the more debt a REIT has. For example, these two here, we have Tritax Big Box, which specialises in warehouses. This has gross gearing of 44.8%, and British Land has gross gearing of 52%. Now, so Tritax has a slightly better gross gearing ratio, but of course you need to compare this with all the other factors mentioned previously. Then finally, we have price to book ratio. Price to book ratio measures a REIT's share price against its net asset value when liabilities are subtracted. Theoretically, a price to book ratio of 1 indicates a fair valuation, a ratio above 1 means a REIT is overvalued, and a ratio below 1 means it is undervalued. So if you can get a REIT at a price to book below 1, that's usually a great deal, as it gives you a margin of safety when investing. For example, if a REIT share price is $1 and its net asset value per share is $2, then its price to book is 0.5. Essentially, you're only paying 50 cents for every dollar of its net assets, which is a fantastic deal.
Two of my favourites in the UK are British Land and Tritax Big Box. British Land offers a London-centric portfolio and a 5% dividend. Then you have Tritax, which is the only listed vehicle in the UK dedicated to investing into very large logistics warehouses, or big boxes, and it currently offers 4.78% dividend. Tritax has commercial clients such as Unilever, Tesco, and even Amazon. For even more diversification, you can invest into REITs via ETFs or exchange trading funds. Now remember, an ETF is just a basket of stocks in a particular market segment. So a REIT ETF is basically a basket of property stocks. A great REIT for UK property investing is the iShares UK Property ETF, or IUKP. The great thing about this REIT ETF is that its top 10 holdings include Sergro REIT plc, Land Securities Group, British Land REIT, Derwent London REIT, Unite Group, Tritax Big Box REIT, and many, many more. Diving into the share price of this ETF, you can see it's down to £4.93 per share. During the 2020 crash, it dropped to £4.37, and its February 2020 high was £6.68. So it's got great potential to rise again. My only negative with these types of commercial REITs is as the high street is moving online and people begin to work from home more, I can imagine the value of commercial office buildings will increase in terms of rental income and longer vacant periods. This could affect the bottom line of many commercial REITs. What about residential REITs? Well, if you would like exposure to the UK housing market without the stress of being a landlord, then residential REITs could be right for you. A popular REIT in this space is the Residential Secure Income REIT, or RESI. This gives you exposure to UK house price rises and a steady income stream via a healthy dividend of approximately 5.6%, with total returns expected to receive 8%. So how do you invest in these REITs? Well, you can invest in them using the free trading apps, such as Free Trade and Trading 212. I have a special link below in which you'll get a free share worth up to £200 or $200 when you sign up. Overall, some exposure to the property market is highly recommended for your portfolio, and an easy way to do this is by investing using REITs. So what are your thoughts on REITs versus direct property investing? Let me know in the comments below and I'll join in the discussion. In addition, if you enjoyed this video, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investing tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Thanks for watching, guys, and I'll see you next time.